A bank operates as an industrial machine that transforms idle deposits into income-producing assets. Every dollar you hand over starts working the moment it arrives, serving as the raw material for loans, bonds, and investments that generate credit every single day. In fractional reserve banking, your $100 deposit splits. The bank keeps $10 in reserve and lends $90. That $90 is deposited elsewhere, and the cycle repeats. Multiplying downward, the original deposit generates $1,000 in credit, expanding the economy without printing new currency. The entire system functions on the calculated assumption that most people will not withdraw their money at the same time. It is a business built entirely on the stability of public trust. For an entrepreneur looking to capture a piece of those money flows, the barriers to entry are designed to be nearly insurmountable. Before you take a single deposit, you will spend 1 to 3 years navigating the regulatory process. You must apply for a charter from state or federal authorities and secure deposit insurance from the FDIC, the seal of which is required for any modern bank to operate. You also need a massive upfront capital injection. Regulators typically require a small community bank to start with $10 to $15 million of its own, unborrowed cash, just to serve as a cushion against future losses. The daily fixed costs are staggering. You must fund compliance officers, expert risk managers, and auditors, alongside massive cybersecurity infrastructure. As seen in these server rooms, the cost of securing transactions and defending against fraud runs into the millions every year. These sunk costs create a brutal mathematical reality. A bank owner begins their journey millions of dollars in the red, creating an immediate and desperate need to scale the business to survive. The core of the banking business is the net interest margin. This chart shows the process. The bank borrows money cheaply from depositors on the left and lends it out at higher rates for mortgages and credit cards on the right. The bank sits in the middle, collecting the spread as its primary income. However, on a typical loan portfolio, a 3% interest margin is rarely enough to cover the massive payroll and technology expenses required to keep the lights on. To bridge that gap, banks monetize the entire ecosystem of transactions. They collect monthly maintenance fees, wire transfer fees, and wealth management percentages. They also earn billions through interchange fees, the small percentage taken from the merchant every time you swipe a card like this one. This makes a successful bank a toll booth for the economy, extracting a small fee from almost every direction that money moves. While most businesses grow by risking their own capital or taking on debt they must personally repay, a bank scales its operations using the money sitting in its customers' accounts. This visual scale illustrates the power of leverage. A massive $500 billion pool of deposits sits on top of a remarkably tiny $5 billion block of the bank's own equity. This ratio allows a modest 1% return on assets to transform into a 20% return on the bank's actual capital. This extreme scale is why JP Chase can generate $58 billion in annual profit. When you multiply tiny spreads across trillions of dollars in assets, the resulting sums become inconceivable. Leverage acts as a multiplier for banking returns, driving high profitability during stable years. But it also means that if assets lose value, those losses are absorbed by that thin layer of equity first. The math of leverage contains a hidden trap. Because the bank holds so little of its own money as a buffer, a loss of just 10% on its loans can render the entire institution insolvent. Washington Mutual provided a case study in this fragility. Under CEO Kerry Killinger, pictured here, WAMU grew into the largest savings bank in the United States, holding $188 billion in deposits. WAMU's growth was fueled by aggressive subprime mortgage lending. When home prices began to fall, represented by these for sale signs, borrowers defaulted en masse. The bank's loan portfolio lost value so quickly that it began to hemorrhage its equity buffer. The collapse was nearly instantaneous. Once fear spread, depositors withdrew over $16 billion in just 10 days. An empire built over 17 years vanished in less than 2 weeks because the assumption of trust had broken. The 2023 collapse of Silicon Valley Bank proved that even the safest assets in the world can be fatal if the economic environment changes. SVB invested its deposits in long-term government bonds, which are considered incredibly safe. However, when the Federal Reserve aggressively raised interest rates, the market value of those older, lower-paying bonds plummeted. SVB was suddenly holding billions in losses on paper. When the bank tried to raise more capital to cover the gap, a modern bank run began. Fueled by venture capital group chats, influential investors like Peter Thiel, seen here, moved to withdraw their funds. Customers attempted to pull $42 billion out of the bank in a single day. Silicon Valley Bank had been operating for 40 years and held $209 billion in assets. It was wiped off the map in exactly 44 hours. Owning a bank means managing a machine that converts public trust into revenue. This structure depends on the mathematical assumption that trust is permanent. The second that belief evaporates, the math collapses instantly.